Good afternoon, ladies and gentlemen. I'm Kritika, moderator for the conference call. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone telephone. Please note this conference is recorded. I would now like to hand over the floor to Mr. Mohit Kumar from DAM Capital. Over to you, sir.
Thank you, Kritika. On behalf of DM Capital, I welcome you all to the Q1 FY23 earnings conference call of Welspun Enterprises. We will start with a brief introduction, followed by Q&A. To start the proceedings, I am handing over the call to Mr. Vinandan Singh, Head Investor Relations, Welspun Group. Over to you, sir.
Good afternoon, everyone. I welcome all of you to the Q1 FY23 earnings call of Welspun Enterprises Limited. Present along with me today on this forum are Mr. Sandeep Garg, Managing Director Designate, and someone most of you already would be familiar with, Mr. Sajid Sutania, Chief Financial Officer of the company, and Mr. Akhil Jinder, Group CFO and Head Strategy, Welspun. You would have already received the company's results, and that is also available in our filings with the BSE and NSE, as well as the company's website, welspunenterprises.com. Which has additional disclosures and information in the investor section there. Do note that anything said on this call which reflects the outlook towards the future or which should be construed as a follow-up statement must be seen in conjunction with the risks that the company faces. As usual, we will start the forum with some opening remarks by our leadership team, and then we will open the floor for your questions. Should you have any queries that remain unanswered after this earnings call, you can reach out to us. With that, I would now like to hand over the floor to Mr. Sandeep Garg. Over to you.
Thank you, Abhi. Good afternoon, everyone. I am pleased to share that our operating and financial performance in the quarter reflects the still unfolding outcomes of our efforts and investments over the past few years. This includes the recent asset monetization transaction that you would be already aware of, where we have signed definitive agreements with Actis for the sale of 6 assets in our road portfolio. This transaction is in line with our stated strategy to operate with an asset-light model. We have also witnessed a significant uptick in our order book, both in terms of quantitatively and qualitatively. The order book as on 30th June stands at 11,900 crores, out of which approximately 1,500 crores is towards O&M and balance towards the EPC. The most important point to note is that with the addition of Dharavi waste water treatment facility project, our average contract value is more than 2,000 crores. The project Dharavi, which was received in this quarter, we have received the letter of acceptance, and is our single highest order with a total consideration of 4,636 crores. This amount is inclusive of GST. I am particularly happy that with this project, which is one of the largest wastewater treatment facilities in India, Welspun will make an important contribution in the city's journey to achieve Swachh Mumbai, which also strengthens the Swachh Maharashtra and Swachh Bharat mission. This large win provides good visibility for sustainable growth. Coming to our Q1 results, as you would have noticed, our performance during the quarter has been strong as far as revenue growth is concerned. It is almost 96% or nearly doubling on a sequential basis, but with subdued margins. Looking ahead, the status of our order book, which is fairly balanced between the water segment and the road segment, water segment being close to 6,450 crores and the balance being from the road with approximately 5,450 crores. There's a clear visibility for growth both in the water and the road sector and the revenue of the company. We are reasonably confident of delivering consistent and robust growth going forward. As regards the pressure on the margins in Q1, this is primarily due to the unusually high commodity price cycle, and as we see the inflation normalizing, which the signs of which are present now, we believe that this pressure will ease off. I would also want to touch upon one of the major operating highlights of this quarter, which is the commencement of toll inflows from Mukarba Chowk, Panipat. This project alone will contribute in the consolidated books approximate EBITDA of 250 crores on an annualized basis till the time the exit transaction, which was referred by me with Actis, does not close. Post which, the company will have corresponding cash inflow, which will make the company a debt-free company and with a substantial cash on the book. This project, that is the Mukarba Chowk, Panipat, and Chikli Tarsor project, are the two road projects which were dedicated to the nation during Q1 FY23. Post this monetization transaction, our road asset portfolio will comprise of two under construction HAM projects, namely Satanathapuram Nagapattinam road project and Antasimaria road project. The balance of Mukarba Chowk Panipat road project is close to completion. This will leave us with the EPC contract of Varanasi Aurangabad road project. As you would recall, both these water segment projects, that is UPJJ
This new order will definitely boost up our execution speed and help us to rationalize and optimize our execution cost as well. In the area of wastewater, you all know that we have won this MCGM order from in the city of Mumbai. That is what Mr. Garg has already explained about the size and the completion time schedule for this order book. On the strong execution in all our projects, we were able to maintain strong revenue momentum during the quarter. On a standalone basis, the company's revenue for quarter 1 was 675 crores, a 96% year-on-year growth as compared to rupees 344 crores in Q1 FY22. On the back of a strong pace in execution front, EBITDA was at rupees 50 crore in Q1 FY23 as against 41 crores in Q1 FY22. Ebitda margin was at 7.2% as compared to 11.7% in corresponding quarter of the last year. The decline in Ebitda margin was mainly due to unprecedented headwinds, including inflationary pressure leading to high input costs and some supply chain disruption, such as seizure of mining operations in Jharkhand, along with the commencement of work on our new orders. We believe the margin to improve going forward with the softening up of raw material prices and the pace of accelerated execution in this newer order. We have achieved PAT of 25 crores in Q1 FY23 as compared to 20 crores in the corresponding last financial year. Now moving to the consolidated performance. Consolidated revenue for Q1 was 822 crores as compared to 413 crores in Q1 corresponding last year, a growth of 99% year-on-year. Consolidated EBITDA for Q1 stood at 151 crore as against 72 crores in Q1 FY22. EBITDA margin for Q1 FY23 was 18.3%. Consolidated PAT was rupees 49 crores in Q1 FY23 as compared to 26 crores in corresponding last year. I would like to further highlight that from this quarter onwards, we will have substantial income adding to our consolidated financial on account of our toll operations, which will be upward trend also on quarter-on-quarter basis, and thus substantially contributing the EBITDA margin at console level. As a company, we are growing consistently, and with a robust order book and enhanced financial strength, we expect the growth momentum to continue in the coming quarters as well. This is all from my side, and we can now open for floor for questions and answers, please. Thank you very much for the patience, Gary.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask a question. If you would like to withdraw your request, you may do so by pressing star and 1 again. We will wait for a moment while the question queue assembles. First question comes from Nikhil Abhyankar from DAM Capital. Please go ahead.
Thank you, sir, for this opportunity. I had a few questions. What is the status of sale transaction of assets, and what will be the cash flow from that to us?
Could you repeat your question? The line was a little choppy.
Can you hear me now properly?
Yeah, much clearer. Yeah.
So, what is the status of the road sale transaction, and what will be the cash inflow for us?
Okay, let me just answer this. This is Akhil Jindal. Basically, the definitive agreements were signed in the month of June, and that's where we have shared with the investors and analysts, the commencement of the deal. Basically, we are in a process of getting the CP complied, which primarily involves the lenders and the NHAI/PWD regulators' approval. So we believe that all of this should be over by, say, end August, early September, and that's the time when this deal, the money would start flowing in. So that's part A of your question. The part B of the question is that how much money as a company will be getting. The total consideration along with the NCA is expected to be in the range of around 2,350 plus. In addition, it will also enable around 300 crores of the working capital ease out in Welspun enterprise level, So all in all, I'm looking at a fund position or a fund transaction of in excess of 2,600 crore. In addition, the debt will also be then transferred to the new owner, and to that extent, our support will also reduce, if not extinguished completely, because our support will be extinguished after completing of all the necessary approvals, which includes the Mukarwa Chowk, our board project, where we have a 49% approval likely to come shortly, and 51% with a policy change. So over a period of time, our support on the debt side will also come down, and also the fund infusion or the new fund into the company in excess of 2,600 crore, as I mentioned. I hope I have answered your question. With all
yes, sir. Just a small follow-up. How do we intend to use the cash?
So, the order book, as you see, is a substantially large order book. So we will become debt-free, which we have debt of about 500 crores at the parent level. So that is something that we will do, and then the balance cash will be available for supporting the current operations as well as for future growth.
Understood, sir. So in the initial comments, you mentioned that the margins were low. So can you give us a specific, like any specific commodity because of which the specific number of commodities because of which the prices were high, and what are the protections that we have taken so that we can tackle this problem going forward?
So as you would recall, practically the whole commodity cycle was upward, whether it was petroleum products, bitumen, cement, steel, and as was talked about that Jharkhand mining closure, so which has led to some input costs going up. As you see, there are decisions being taken at the governmental level to ease out. The inflation is down. The steel prices have relatively eased up. Relatively, cement is also eased up to some extent. So the relative pressure is up on the commodity cycle. So we look forward to that, and with the monsoon being forward, there will be a further ease off on the cement and steel prices is what we anticipate. So we believe that this temporary blip is a quarter or a 2-quarter issue.
Okay, sir, understood. And one final question. We have won a large order from BMC. So how will it affect our revenues in the near future? And do you see any other large opportunities like in the next 1 year?
So this large order of NCGM is a 5-year contract for the EPC. The first year is going to mostly be devoted to preparing the ground for work as well as the engineering. The real work would begin possibly about 9 months to 10 months after the project is awarded. And so this year I don't see it substantially causing much of a revenue. However, we have major projects like Varanasi Road project, Satanath
as well as the corresponding numbers as of 31st of March?
I don't have those readily. If you could get in touch with my team, they would be very happy to answer those.
Okay, all right. Sir, we have seen that the delay has been happening in the execution, especially in those two projects, SMRA and SNRP. So, can we, let's say, assume that projects will have speedy execution going ahead, as in the current fiscal as well as the next fiscal?
That is correct.
Please go ahead.
That is correct. The SNRP, the debottlenecking of the, as you know, that there was all the Tamil Nadu projects were having problems relating to the earthwork and the pond ash. With the intervention of the government, central government and the state government, the things have started to ease off. And we've now started getting earth. We are quite hopeful that in next few months the pond ash issue is also going to get resolved. So the structure work has been progressing at SNRP. The question was which is getting resolved now. So we are very confident that SNRP will start turning substantial revenue going forward. As regards the Ebitda Margin, we are already, the bridge section is already substantially moved ahead. However, as you know, because of the work being on water, the time period available for working on the water is somewhere around 6 months. So it will be a bit slower on the bridge side, but there will be a much faster work on the approaches, which have started. On which we have started the work, because now the fronts are available to connect the bridge from both sides.
Okay.
Another thing that I would also want to say that Ebitda Margin, there are certain changes because of the railway requirements. So certain RUB requirements have come in, for which the approvals are now in place from railway, and hence that particular section is also stands debottlenecked.
Okay. No, but I believe that the earlier for Ebitda Margin was FY23, and now I think you have just stated December 23. So, what is the reason for delay? So I think in the last quarter only we mentioned that Ebitda Margin will be completed in FY23 itself. Now you are saying December 23.
Because let me. The reason is because I said there was a requirement of ROB stroke RUB from railways, and railways approvals have come now. It's a major railway track which has because of the configuration of railway tracks, there is a requirement to convert one of the ROBs to RUBs. Otherwise, the access is not available, and which took us some time for it was with the intervention of Pragati that this resolution could take place between Railway and Ministry of Road and the NHAI. So now with this having come, we are entitled to an extension of time of approximately 500 days, which we will get. Since this is now debottlenecked, is why I am telling you that we are expecting this to be completed by December 2023, because there is a process of building the RUB, which has now been approved, which is a time-consuming process.
Okay. All right. My question be, what is the total L1 at this point of time, and can you please give any guidance on the fresh order inflows for the current fiscal?
Sorry, I couldn't follow your question. Could you repeat, please?
Yeah, I'm saying what is the total L1 at this point of time, and if you can please give some guidance on the fresh order inflows for the current fiscal.
LOA. Yeah, I think as far as LOA is concerned, we have only LOA in this MCGM project which we have talked about.
Okay, and any guidance on the fresh orders?
Guidance on placeholders.
So we have substantial orders, and as I said, we are very selective in our order book. We want to take strategic orders. So we have substantial, as you would know, even with a substantive growth rate, we have a clear visibility of orders for at least 3.5 years. So we will be very selective in picking up the orders. However, strategic orders we will take.
Okay, all right. So just one last question.
Sorry to interrupt, sir. Sorry
Yeah,
to interrupt.
okay, I'll get back in the queue. No problem.
Thank you, sir. Ladies and gentlemen, if you have a question, please press star and 1 on your telephone keypad. I repeat, if you have a question, please press star and 1 on your telephone keypad. We are having a question from Rohit Natarajan from Antique. Please go ahead.
Yeah, thank you for this opportunity. So my first question is more to do with this top management change that we have seen. We are glad to see Mr. Garg back into the business. But what seems to be this reason for it? And does this particular changes would impact our strategic thinking, execution in the days to come? If you could throw us some color on those aspects, it would be great.
We would have wanted Ajay to take this forward. Whatever we are talking is something that Ajay and team have done in the last quarters, which are duly supported by the board and the group. However, Ajay had his personal reasons to move on, and the board, in its wisdom, decided to recall me. So that is, the advantage being that I have practically for last 10 years, barring for this short period, been with the company and seen its growth. So hopefully I will deliver the results as are expected.
Sure, sir. Apart from that, is the role that is MD and CEO will be separate? I mean, what exactly does the new way of thought process goes ahead?
We are right now continuing. However, there can be always new opportunities going forward.
Sure, sir. Coming on to the company-specific questions, that is, we have got a very good asset monetization in place. I understand in your opening remarks that you will be using it for future growth opportunities, as I understand. But could you please directionally guide us as in where exactly this cash will be deployed? Would it be more towards road projects, HAM projects? If not HAM, will it be in BOT projects? Or would you be going for an inorganic growth opportunities? Any color on those aspects, it would be great.
So, see, as I said, we are looking for strategic building of order books. So we are not any projects in the sector of road and water segment, which is strategic and gives us a return in the ranges of 15% and above, is something that we will look at this cash.
Sure. So, in principle, we are focused on EPC business. We don't have, maybe strategically we will have some asset heavy model, but largely we will do EPC business. Is that the understanding correct?
We have all the HAM, the BOT, toll, everything as within the portfolio and open as a business opportunity. As I said, our governing principle is it should be strategically right for us to enter into that project, and it should give us a return of more than 15%. these criteria, which whatever of the options of the models will allow, we will be looking at that option.
Also, 15% it is not just on our own invested equity, but on an overall project basis is what we would be mindful of, because ultimately if there is any debt being taken on the books of the company, we believe that is also our exposure, and on an overall basis we should be a return of 15% plus. Then only this money would be deployed.
Sure. I appreciate, sir. So final question from my part. Given that we have got such a huge order backlog, 6x book bill, I understand that there will be a bump in revenue, and you've been guiding may not be in the very immediate term. It will take a little bit time. But could you just give us some, like the peak revenue will we achieve the peak revenue by FY24? Will we be doing 3,000 plus kind of number? Any color on those aspects, sir, would be great help.
Yeah, we should definitely be touching those numbers. For sure, we'll be next for the current financial year and the next. We should be touching and being above those numbers going forward.
Got it, sir. But also on the margins part, now that I understand this was a transient issues that we have had in the last quarter, but would it mean that we will be back to 9 to 10% Ebitda margins once we do the peak number?
Sure. We are definitely confident that.
We should be in the range of double digit as we move forward, and we are very hopeful that we should be closer to this.
Thank you, sir. That's it from my side. Wish you all the best.
Thank you.
Thank you, sir. Next question comes from Ritesh Gandhi from Discovery Capital. Please go ahead.
Yeah, hi, sir. Hi, I just wanted to understand, after this acquisition transaction, how much would be the net actually cash on books overall at a consolidated level?
See, today we are at a net debt of around 400 crores, if I am not mistaken. Exact number, Sanjeev, you can just tell me. But with this, total free up of the cash will be in excess of 2,600 crore. So I think on a net debt basis, we would be around 2,200 crores. 2,200 crore plus. Yeah. I mean the zero debt on the books. Yeah. And 2,200 crore plus, and on the console side also, out of the 6 assets which is getting divested, all the loan will go to the buyer. Yes. So left out on the console also, at the moment will have only one company, one project which is Antasamaria, which will carry debt. Otherwise there is no debt after this transactions get consummated. And SNRP. And SNRP is not at the moment, but going forward it will come as we get discussed.
Got it. So, that's a reasonable amount of the cash on books, and I understand that while the order book is also actually large, we are meaningfully under leverage. So just wanted to understand, is the plan to actually deploy it into infrastructure only, or are there some new areas we are looking at, or is it to return it as like a capital to effectively shareholders? How are you thinking about it? Because even based on the existing order book, we've got way too much like cash on books.
See, in the infrastructure, as you would recall, the journey when we started to grow in infrastructure, we had created a war chest of about 1,000 crores, and we propelled the company to current order levels. So we believe if you have a war chest of this kind, we will have the next phase of growth. That's what our belief is, and that is why we would want to retain this cash, and as we said, and deploy it in projects which can give a project IRR of 15% or therearound. We believe that there's opportunities out there to deploy it successfully once the cash is on the book.
Good. So and the other question was, going back to the journey which after the solar asset sale we were deploying into infrastructure. At that time, our expected equity returns were closer to 18% with an aspiration to go over 20%. Just wanted to understand between what the hand was and what actually ended up playing off, actually what our learnings were, and is there a reason why we are happy now with 15% project IRRs, or effectively that's all that we actually should be able to expect in an industry like this?
So yeah, that's why I clarified in between that this is not 15% equity IRR, this is 15% project IRR.
Okay.
And with the project IRR of 15%, with a gearing of say 2:1 or maybe 3:1 as maybe permitted in the infrastructure sector, our equity returns are in excess of 20%. So we have maintained on that path, which we have guided you at the beginning, and always had been mindful of the cost of equity being the highest in the pecking order. And to that extent, we have always respected it in the bidding and as well as in our exit strategy. So the shareholders' interest has always been kept aligned, along with the returns that we have projected for our bidding and for the exit strategy.
Got it, understood. But effectively, they're like capital heavy because on one hand we are indicating we are preferring to do actually a light project, right? And on the other hand, we are retaining 2,200 crores of the cash with a potential to gear up 3 times. So let's say anywhere between 7.5 to 10,000 crores on projects. So just want to understand how should we sort of be thinking of the difference between the two?
So we are trying to. This is like as I said earlier also. It's trying to create all spokes of where we can stand on stable footing. So there will be a developmental model which will deploy the cash. However, there will be a stable EPC business which gives us the return without the capital investments. And that's the diversification we also made into water. So it's to as the company is going big, the intent here is to make it come to a stable platform and have offerings which can both work when there is a liquidity on the balance sheet, and also when there is limited liquidity as the deployment of cash takes place. Growth has to continue, and that's the business model that we have come up with. So we will be working on 2 sectors, that's road and water, with the offerings both of the EPC and the investment model, which we believe will give us the stability that is required for a sustained growth.
Got it.
This is Sanjay here. Yeah, this is Sanjay here. In addition to what Mr. Garg has said, our asset light model philosophy will always remain. Though we will get cash in our books by this active sale, but as we know that order book in EPC side is more than 10,000 crores. This will also require certain working capital side, not from the asset side. As you see, as a mindset, we are not that aggressive, or we are very conservative in utilizing the borrowed fund as a working capital. So this money will also get consummated to some extent to retire our term debt liabilities, as well as use against our EPC order book as a working capital, not to buy the capital assets. But as and when we get the opportunity, as mentioned by Mr. Akhil Jindal, to our mindset of getting the right IRR, we will get into it.
Correct. Just a last question. Historically, and I think we've discussed this also, that EPC is not typically have been extremely lucrative. So just wanted to understand how that thought process has changed, and effectively, if you all are now looking to use actually equity on books as opposed to even levering it up, how do the EPC returns then really accrue to actually equity shareholders? Because I would assume if you don't even use the leverage, you may not be able to achieve your sort of adequate return on equity on a highly competitive EPC project.
So let me take this question. The EPC, if our offerings are primarily EPC in the road, your observation would be absolutely right. So our focus on EPC on road is primarily on a strategic level rather than on a bidded level. We are more focusing on water segment where there is a differentiation through engineering and design optimization, where we believe that even the EPC gives us the desired returns as opposed to pre-designed road or very straight line road construction. So we are very mindful of the bottom line. So when we take the EPC contracts, they have to be strategic and should have to meet the threshold return requirements as have been specified, so which is sacrosanct for us.
Got it. Understood. Sir, congratulations on your transaction and all the best. I'll get back to you.
Thank you. Thanks a lot.
Thank you, sir. Ladies and gentlemen, if you have a question, please press star and 1 on your telephone keypad. I repeat, if you have a question, please press star and 1 on your telephone keypad. Ladies and gentlemen, if you have a question, please press star and 1 on your telephone keypad. We will wait for a moment while the question queue assembles. We're having a question from Saurabh Agarwal, an individual investor. Please go ahead.
Hello, good afternoon, everyone. Sir, I just have a very basic question regarding that deal which was informed to us in June last month about the sale of these projects, and the tentative timeline has been given by 31st March. The deal should be over. So, could you please give us any update on this tentative timeline? Is it going to be expedited, or 31st March is like the ultimate time period we should take? Thank you.
Yeah, I think we answered in the beginning. In fact, we are looking at multiple rounds of closing in this transaction, and we believe that in around 31st March 2023 is when the full deal will be concluded. Of course, subject to the NHA approval for the balance 51% equity sale also from which currently is under evaluation at NHA, not yet finalized. But I think all in all, we are looking at a perhaps say June quarter or something next year for the full commencement. But as I mentioned, the closing will happen in multiple rounds, and we are expecting the first round of money to be available sometimes perhaps if we are lucky within this quarter or at the beginning of the next quarter.
Okay. Thank you very much, sir. Thanks a lot.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have a question, please press star and 1 on your telephone keypad. We are having a follow-up question come from Ritesh Gandhi from Discovery Capital. Please go ahead.
Yeah, just a follow-up, just to understand, how much was the equity IRR we were able to generate out of the projects which we sold?
All in all, it was a 1.5x of our invested capital.
Yes.
So it was a 1.5x. I'm sorry, I don't have that IRR percentage handy with me just now, but I would ask my team to circle back.
Okay, got it.
But on a price to book basis, it was 1.5 times.
Yeah. We saw that in the release. Sure. So, and the other question, I just want to understand with regards to how are you seeing the kind of competitive intensity now on the HAM side and the water side on the EPC side, and do we feel given effectively, the equity IRRs, I think for the projects which we sold may have been slightly lower than our expectations. How are the things going to change going ahead, and the learnings we've had from a historical transaction?
So, first to answer the question of competitive intensity, I think the competitive intensity in the interim period on the road projects has been extremely high, which is now seeing some reduction. We have stayed away from very highly competitive environment in the road because the pricing was practically going into negatives of ranging from 10% to 25%. Not an area that we want to play in. However, the recent awards, few of them are about 5 to 10% above the budget. So we think the control is coming back because there's enough orders which are not seeing financial closures. So I think the competitive intensity is reducing, and in another a quarter or 2 quarters, I think the playing field should once again be established. In terms of the offerings, the government is now realized that the booth model initially without any guarantees on the traffic, every traffic risk being taken by the developer is not a model that can sustain. So there is a thinking going on, which I believe will make the risk and reward equation a bit favorable. So we will be looking at those developments and to decide if it can give us the adequate returns. On the water side, plain vanilla small value contracts, intense competitive intensity in water. However, we have seen that the higher value contracts have limited players and limited competitive intensity, and that's the area that we will be in.
Good. Understood, sir. That's helpful. Thank you. That's all from me.
Thank you, sir. And that will be the last question for the day. I would now like to hand over the floor to Mr. Sandeep Garg, MD of Welspun Enterprises, for closing comments.
I would want to correct you that I am not a manager. I am the managing director designate. Managing director still continues to be Mr. Ajay Hans, who will relinquish the charge on 8th of August. I am stepping in on behalf to address this because he has his own personal commitments. I would want to thank all of you for joining us on this call today. Your questions have been insightful, and I appreciate your interest in Welspun Enterprises. I look forward to speaking to you once again during the next quarter. Meanwhile, please feel free to reach out to Abhinandan for any clarifications or feedback. I also thank Mr. Ajay Hans, the Managing Director, for the support that he has given the company during his tenure. Thank you all. Good day.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Doorsabha's conference call service. You may disconnect your lines now. Thank you and have a pleasant day.
Your conference is no longer being recorded. Your conference is being recorded. Your conference is no longer being recorded.